Greetings. Welcome to the continuing lecture in corporate finance. This is Dr. Jeff Hong, and we're going to be talking about the examples of real options. So in our last class, we basically stopped here at the example 12.3. So let me just quickly recap what this problem was about. So this Wingfoot Shoe Company, right, had that we discussed in example 12.2. This company has a potentially excellent demand, right, as described in the example here, right? In other words, in which case they would have possibility of excellent demand in year 2 and 3, right? I mean, moving along the top branch or upper path, right, where if in year 1, if the demand is good, right, with the probability of 60%, and then in year 2, you have a probability of excellent demand, 30% probability that the demand will turn out excellent. Otherwise, there is 70% probability that the demand will still just be good, right? And under each scenario, right, the cash flow in year 2 and year 3 will be different, right? In excellent and in good scenarios, right? Of course, here's the thing. If the demand turns out to be excellent, that means, the demand will increase. The demand will be greater than just, when it is, good, right? And then to meet the increased demand, then you will need to have greater production capacity, and the greater production capacity requires, building more, adding, think about it. If the current plant size or the current plant capacity is maxed out, then you will need additional capacity, and additional capacity requires additional construction, right? And additional hiring of equipment and machinery, right? So here comes the issue. So we're going, let's get back to the, if that is the case, right, if it turns out to be excellent, right, is there a real option, right? Is a real option present? And the second, part B, is suppose if, and I'm telling you straightforward, and just like in the last class, yes, the real option is present, right? There is a real option, because it has to do with option of acquiring more space and acquiring more equipment, right? But as we assumed, right, if the plant was running at full capacity, right, then the space is maxed out. There's no more space. So then what does that mean? You will need to build additional plant space, right? In other words, add additional plant space, right? To put in additional equipment and machinery. But think about it. If you start adding the space to the plant in year two, it's going to be too late. I mean, construction of new plant space will take at least 6 months to a year or even more, right? So that's going to be, once it may be completed after that, excellent demand. In other words, while there's an excellent demand and you don't have the capacity to increase the output to meet that demand, then that demand will be picked up by your competitors, right? It will be picked up by somebody else. So you cannot start the production in year two, right? You cannot start the construction in year two. The construction of additional space must be already incorporated in the plan, right? Before time zero. In other words, when you are planning, you must incorporate this. And if it is done, it will cost $500,000, right? But it must be done at the project's outset, right? At the beginning, right? Because, but then think about it. This space will be just wasted if the demand doesn't turn out to be excellent, right? In other words, there's first of all, 60% probability in year one that the demand will be good, and then there will be a 30% probability that the demand will be excellent, right? So that means, there is, 18% probability that it's going to be excellent. But on the other hand, 6 times 60.6 times 0.7, right? 42% probability that the demand will just be, good, not excellent. And then there is also, the bottom path, right? Bottom branch where demand will be just poor. So there's more probability that actually, demand won't be excellent. So what if it is the other scenario that it's not going to turn out excellent? Then that $500,000 space will be wasted. So we have to incorporate. We have to plan everything already, in the capital budget before we start out, right? And also, remember $1 million for expansion in year two it's not about space. It's about, plant, the equipment and machinery. I mean, you can buy acquiring equipment and machinery doesn't take that long, right? But the space would take a lot of time, right? Building additional plant factory space, right? So that has to be done, already, included in the original plan at time zero, right? Should the expansion of the space be purchased under the conditions in 12.3? So let's take a look at the tree diagram. But this is basically, the reasoning about it. In example 12.2, Wing's factory is at full capacity at a sales level consistent with good consumer acceptance, right? So actually, this is we already talked about this. I mean, I don't want to repeat the same thing, but here I already talked about that. Um, so here, the opportunity to respond to the excellent consumer acceptance by expanding the plant is a real option. Yes, that I already answered. Um, that is, management has the option to expand the capacity at an incremental cost to meet the higher than expected demand, right? Higher demand than the expected demand. But so far, what that means is until up to example 12.2, there was no cost associated with this real option. But now we have cost associated with this real option, which is $500,000. So having the extra space from the beginning gives the real option to expand. Without it, management has no choice. And therefore, that means therefore, to decide whether to purchase extra space, we need to place a value on the ability to expand. And then, so in other words, we need to put a value on that option to expand, and then compare that value with the cost of the option, right? So then, what is the option's value? What's the real option value? It's the expected net present value with the option minus the expected net present value without the option. Of course, without the option, expected net present value without the option, we know it from example 12.2. And 12.2 was, just, no expansion, right? So the difference between the two is certainly the value of that option, right? So we calculate an expected net present value without option, right, in 12.2. And then we also calculated in 12.3. So the net present value, expected net present value, in other words, weighted average, right? Net present value with the option is 1.388 million, right? That was what we already calculated. Net present value without the option is 969. The difference between the two is 419 and $419,000, right? That's less than $500,000. The real option value is less than $500,000. So, which is the cost of the option. So, the management shouldn't buy the space for this potential expansion ahead of time, right? So, I mean, it's straightforward. The conclusion is, it's not worth it. But however, there may be another reason to consider keeping the expansion option alive for other, possible situations. But first of all, let's recap what we already did this in the previous lecture, but previous slide. But let me use Excel to explain that again. So so this is example 12.2. Oh, okay. Let me switch. Okay, let me switch the application from. Alrighty. So you see this now. You see the Excel. So this is example 12.2. And I put it like this. This is, of course, timeline, cash flow. And we have only two probabilities, good and poor, right? And there's a 60% probability. Of course, in year one, I mean, at time zero, initial investment is, 5 million, right? And the present, and there is 60% probability it will be good. There is 60% probability it will be poor. And then we find the present values of these cash flows, right? And of course, you already know what to do, right? You can simply, discount it by the 10% cost of capital, right? 83, right? And raise to these time digits, and then you drag it down. We'll come to these, and we'll sum everything. Now, this is already present value, right? Because it's time zero, right? It's cash flow at time zero. So if you sum everything, right, it's going to be automatically subtracted, and the net present value will be this. But then that is subject to 60% probability, right? So probability weighted net present value, right? The probability times that. Okay, we come to that, and then if it turns out to be poor, right? We already know, and then this is the net present value at the bottom path, right? Along the bottom path, bottom branch. Now, then probability weighted, right? Probability times net present value. Probability weighted is that. And our weighted average net present value, which is also expected. So another name for that is expected, right? Expected net present value, or weighted average net present value. Yes, simply, add them up. We come to 968, right? Remember, this is the value of the, this is the net present value without the option. Now, let's find the net present value with the option. So this is 12.3. In 12.3, you have in year one, there is 60% probability and 40% probability that it will be good or poor. But from year two, there is 30% probability that it's going to be excellent, and there is 70% probability it will be just good, right? And then once again, the probability is going to be excellent in year two will be, conditional probability, right? In other words, good must happen first, right? And then excellent happens, right? And this is like, good probability of the demand turning out to be good, and in year one and in year two, right? So anyway, the technique is pretty much the same. Now you understand why it is cash flow in year two is $4 million, right? Because this is the balance, right? In other words, it's $50 million, right? I mean, $5 million cash inflow, but you have to invest $1 million, right, for machinery and equipment, right? So that is, a cash outflow, and $5 million is cash inflow. So a balance is $4 million, right? So here, right, we got, and then this is, you finding the present value, right? Same technique, right? Okay, and then net present value along the upper path, right? Excellent, right? Is this, and weighted probability weighted, right? Probability weighted net present value would be this times this, conditional probability, right? Or joint probability, talked about, joint probability, a distinction between joint probability and conditional probability in our last lecture. So that's what it is. And then if it is good, again, we come to this, right? And if it is poor, right, we come to this, right? And then expected net present value, right? Expected net present value, which is weighted average of, this is already weighted, right? So all you need to do is just add them up, right? Then 1.388 million, right? When you round it, right? Okay, so that is, how you would do it in Excel. This is the way I set it up. It can be set up differently. Also, I can call this expected net present value, right? Expected net present value. I labeled it weighted average net present value, but oops, why? Oh, there must be something that's keeping it. Yeah, down there. Something's keeping it like that. Expected. Net present value. All righty. There's something still further down there now. Why? Oh, because of this. Okay. Merge and center, and then we'll. What did I do? Merge and center. This is a little, you might you might find it non-essential. Yeah, it's not. It's just housekeeping, right? It's not an essential thing in Excel model, but a good form is always important. Good form, right? Good form is always important. Meaning that yeah, good form is always better than okay. Makes the whole difference between the professional looking model and just barely loosey goosey and barely botched model. They're looking really botched. All right. Anyway, that brings us back to our slide. And then let me do this, stop, and switch to the slide. Okay, so we're back, and so let's see why. What would be the reason? What would be that another reason to consider keeping the expansion option alive? Is because of the abandonment option. Abandonment. So here's the. Let's take a look at the abandonment. Uh, so poorly performing project can be abandoned, right? If it is poorly performing, and but it can be salvaged, right? Plant and equipment. Um, or cash from their sale may be better used elsewhere, right? So it often takes planning to preserve an abandonment option in case it doesn't, uh, if it flops, right? If it doesn't, take off, then at least we will have to abandon it, right? But then, it can be put to a better use, or at least to mitigate the risk, okay, or mitigate the loss, okay, by abandoning the project and putting it into uh, altern- alternative use. Okay, so here let's take a look at the. So Wingfoot has other lines of shoes in which most of the equipment purchased for the running shoes project can be used if the new idea is abandoned. So let's say the excellent, blah blah blah, all that. It doesn't happen, right? So then they can use it for something else. I mean, if it was supposed to be for running shoes, what about, what if can it not be? We don't. Okay, let's not do the running shoes, but can we use this equipment for, let's say, uh, tennis shoes, or basketball shoes or something like that? So the management estimates that at the end of the first year, the equipment's value in those other uses will be 4.5 million. Right? If it is used in other project, its value would be 4.5 million. How does this information impact the analysis of the running shoes project? So if the project is abandoned and the equipment is redeployed at the end of the first year, cash flows along the bottom path of the decision tree, 12.3, would be 1.5 million plus 4.5 million, and that would be 6 million in the first year. Okay, so in other words, there is 40% probability it will flop, right? I mean, that's the bottom path of the bottom branch of the tree, right? Tree diagram. So if that happens, then instead of, you can, uh, uh, I mean, I'm sorry, I got it mixed up. If in the running shoe project in the upper, right, upper path is abandoned, right? Then and it gets the additional equipment gets redeployed, right? In like let's say basketball, tennis shoes or basketball shoes, right? and then it will still generate 4.5 million, right? And in the bottom path, right, it will be, total of, because, the if this happens, that means, if abandoning happens, right? Abandonment happens, that means uh, it would be the uh, poor case scenario, right? Poor case, uh, because the good, excellent case didn't transpire, right? So you will have still, 1.5 million in the first year, right? And then, 4.5 million from redeploying the equipment in the tennis shoes, right? So it comes to 6 million in the first year, and you won't pursue this anymore. So there will be no year 2 and 3, right? You won't pursue the running shoes anymore so there won't be any cash flow in year 2 and 3 from running shoes, right? So NPV, net present value, along the bottom path would then be as follows, right? Initial, right? Investment, and then present value of this 6 million. It will come to then 455 million, which is at least positive compared to the original scenario, right? You see, if it is poor, right, the net present value under that scenario would be negative, but at least the bottom path, right? At least it won't be negative, it will be positive, right? So so we recalculate, expected NPV, assuming the bottom path replaced by abandonment, right? And in the original okay, let's go back to the original example, right? So if it was poor, it would be net present value on the poor scenario would be this, right? But that will be replaced by 455, positive number, right? And then, the probability is being weighted, right? And then eventually expected net present value will be 2.078, 2 million, right? 2.078 million. So the abandonment is an option available to the management that increases the project's expected net present value. In other words, abandonment is not just zero, right? It has, positive. It can have a positive effect on the net present value, expected net present value. Therefore, if abandonment is possible, it's a real option. And existence of abandonment option lowers the project's risk substantially. Yes. Because in the poor, right, case, right, in the poor scenario, right, you still have positive, not the negative, net present value. Oops. Original project has a 40% probability of a negative net present value, right? A negative, right? This parenthesis means, right? I've been telling you, right? Three ways you can express negative number, minus sign, of course, and red font, or parenthesis, number in the parenthesis. Such a loss could ruin a small firm, right? If it was a small firm, it could this kind of loss, 1.2 million, could ruin the firm, and that's all the more the reason to avoid the project altogether. But if the abandonment option exists, as described, loss becomes a 40% probability of a small gain of, right? Loss of 1.27 million becomes a 40% probability of a small gain of 455,000. Makes the project taken as a whole a lot less risky. And it is unlikely that a firm would avoid a project because of the risk of ruining the company, right? I mean, once the abandonment is possible, right? All righty. So we already know how to value the real option, right? Basically, value of the real option is net present value, expected net present value with the option minus net present value, expected net present value without the real option, right? Real options can be worth more than the impact on the expected net present value. That's why that's why we talked about the abandonment, right? I mean, normally, in the example 12.3, you saw that the normally, because the value of the real option is less than the cost, you would think, you wouldn't, it's not worth it. But because of the another reason, which is, the value of the abandonment, right? So it can be worth more than the impact on the expected net present value. And then an abandonment option is, we talked about it, generally reduces risk. However, risk effect is tricky. Not all real options have a risk effect. To mitigate risk, an option must improve expected net present value by reducing potential loss rather than making success better. Right. To mitigate risk, right? What's important is, I mean, if you making success better doesn't do anything to mitigate the risk, because success is already success. That's not the risk, right? So rather than making success better, reducing the potential loss would improve the risk situation. In other words, it would mitigate the risk, right? So in case of Wing Food's expansion option, profits are higher if things go really well, but there's still a 40% chance of big loss. But then this 40% chance of big loss turned into a 40% chance of small gain with the abandonment option, right? So it's we need to do a case-by-case analysis, right? Now, we can also approach real options through rate of return. If lower risk is associated with a lower rate of return in net present value calculation, now think about it. If, in other words, cost of capital goes down due to different real options, right? The lower risk is due to lower, K, cost of capital or rate of return in NPV calculation. If this discount rate is lower, it will result in higher net present value, right? But we already know cost of capital plays a key role in both NPV and internal rate of return, right? For net present value is discount rate. Higher discount rate, cost of capital leads to a lower net present value, reducing the chance of project acceptance. Internal rate of return is compared to cost of capital. A higher cost of capital leads to a lower chance of project acceptance, right? So that means, for a riskier project, you would, of course, by now you should all know, for a riskier project, you should use higher discount rate or higher cost of capital. Then you can avoid or prevent accidentally accepting a risky project, right? So that's what it, I already explained. Riskier projects should be less acceptable, right? So if you use a higher risk-adjusted rates, then it will lower the chances of that risky project being accepted. Starting point for risk-adjusted rates is the firm's current risk level reflected in its cost of capital. Yeah. And then a firm's current cost of capital and relating, this is something we already did in cost of capital, right? In that risk premium method, right? And CAPM, right? Interest rates are, interest rates are basically, interest rates consist of base rate plus risk premium. It says risk premium, but actually there are multiple risks. So there are different types of risks, at least there are 4 types of risks, default risk, inflation risk, maturity risk, liquidity risk, So it should be called risk premia, right? Risk premia, because it's plural. But anyway, it's fine, risk premium. We are, in this case, we are talking about some, specific risk related to the real options, right? That can be reduced by real options. Or now, investors demand higher risk premium and interest rates to bear more risk. Yes, of course. The higher the risk. In capital budgeting, right? The company is the investor. Yeah, of course. So cost of capital is appropriate, but the company's cost of capital is appropriate for an average risk project. So you will need to add risk premium for different, levels of risk. Okay. And so this is basically, how you, the risk premium method, right? And we already, talked about this in, right, remember, in cost of capital. Now, but this is an, if you use risk premium, right, if you add risk premium, it's an arbitrary and subjective process. 3 categories of increasing risk, right? Of course, and I've been telling you, depending on the nature of the project, whether it is replacement, expansion, or new venture, right? Risk premium would have to vary. If it is simply risk replacement project, right? Uh, just use it's just companies average ordinary uh, projects. So the risk is just companies average, right? Low risk. Just use companies weighted average cost of capital, right? If it is expansion, slightly riskier than current level, so anywhere between 1 to 3%, right, to cost of capital. New ventures, remember, anywhere between 3 to 5%, right? Risk premium between 3 to 5%. Generally involve new ventures involve a lot more risk. Choosing risk-adjusted rates is difficult and arbitrary. Sometimes get help from a CAPM, portfolio theory. CAPM. So this is we already know this from capital budgeting and cost of capital. A project is a diversified portfolio. Why? Well, a company can be viewed as a collection of projects. We talked about this. A new venture diversifies the firm, right? A new venture can also be diversified. A new venture also diversifies the stockholders' investment portfolio. Yes. If a company takes on a new venture, right, by buying shares of stock in this company, my stock in this company is already diversified, right? So my entire portfolio gets diversified more. And as an example, I've been telling you, I've been using, I'm sure I've been using Tesla as an example, because Tesla is just, a single company, but, it's an auto manufacturer. But look, it's owned by, Tesla is owned by a holding company, right? Which also owns, SpaceX and Hyperloop. Hyperloop is the company, and Boring Company. The name of the company is Boring Company because it is boring the tunnel, right? Underground tunnel for Hyperloop. And Hyperloop is a super fast transit system, right? Which uses like a vacuum tunnel, tunnel they build, underground between, LA and San Francisco, and then there's a shuttle that travels through this tunnel, and this tunnel is called Hyperloop, and it's basically using suction system, right, vacuum suction, right? So you get onto the tunnel, the shuttle, and zoom, the shuttle gets sucked into the loop, the tunnel, and then arrives at the other end, San Francisco, in like 30 minutes from LA, right? So, but think about it. They are separate companies, but the holding company of those three different companies is one and the same. I mean, Elon Musk is the chairperson of the holding company that has invested in all these three companies, right? So basically, it's a collection of a company is, a collection of, diversified portfolio, right? Now we understand, there is, from principles of finance, we all know there are diversifiable and non-diversifiable risk, right? Non-diversifiable risk is called systemic risk, right? The projects have two levels of diversifiable risks because they are effectively in two portfolios at once. Some risks are diversified away within the firm's portfolio of projects, and some risk uh, is diversified away by the shareholders' investment portfolio. And the remaining risk is the systematic risk. Okay. Okay. So diversifiable and non-diversifiable, right? So this is a diagram that's total risk comes from systematic risk and the non-systematic risk or diversifiable risk, right? And part of which is diversified away by the portfolio, company's project portfolio, and additional risk is diversified away by stockholders' investment portfolio. And we're not going to go over CAPM again, security market line, which is basically the theory behind CAPM and beta. Right? So calculating the risk premium, right? You can use to make adjustment for the risk. You can use a risk premium method, but also you can use CAPM. But here's the thing. If if a project is viewed as a business in a particular field, use the beta common to that field to estimate a risk-adjusted rate for project analysis. But here we have a little problem, right? So your project, just like SpaceX, right? This is a business in a particular field, right? So you want to use beta for common to that field, but who else is in the is that an established field? Space travel, right? SpaceX. I mean, at least I believe there are 2 to 3 companies that are in this space travel business. SpaceX being one, and the names of other companies escape me, but think about it. Most companies are not. Most companies are not a just single division. In other words, Tesla is a Tesla or SpaceX or Boring Company. They are very unique examples because Tesla is only an electrical vehicle, right? SpaceX is space travel, right? And Hyperloop is Boring companies, just excavating, and constructing, transit system, mass transit system. But then most companies are a collection of, as you can, as we discussed, they are a collection of different other projects or different other lines of businesses, right? In other words, most companies have they reflect a conglomerate nature, right? So it's hard to find a company, right, to use beta common to that field And it's hard to find a field where the companies are only uh, doing that line of business, right? It's generally called pure play fund, pure play, um, used when an independent, publicly uh, traded firm can be found in the same business, right? That's called, can you find among all the uh, companies listed in the Nasdaq or S&P 500 or Dow Jones, publicly traded among the publicly traded firms, can you find any company that is a pure play firm? Hmm? They generally do. Uh, they're not making only you know they're not only in a single line of business, right? Even automakers, yeah, they make cars, but and they're not making only uh, they're not making only cars. They make trucks, they make specialty vehicles, and also some of these companies have owned their own, uh, these days, they generally, outsource the parts, but sometimes they can make their own parts on their own if building those parts in-house is cheaper than, importing it, outsourcing from another company, right? Um, so you can, if you can find pure play firm, yeah, you can use their beta. But it's hard to find. In reality, it's kind of hard to find it. So let's take a look at this example. Orion Inc. is a successful manufacturer of radio communications equipment. Management is considering producing a sophisticated tactical radio for sale to the Army, but is concerned because the military market is known to be quite risky. The military radio market is dominated by Milrad Inc., which holds a 60% market share. Antex Radio is another established competitor with a 20% market share. Both Milrad and Antex make only military radios. Okay, so these two companies are major competitors in the military radio market. And of course, the other 20% is, obviously the other smaller competitors are all, making up that 20%, the other 20%. Both Milrad and Antex make only military. Milrad's beta is 1.4, and Antex's beta is 2. Orion's beta is 1.1. Look, Milrad's beta is lower than Antex because Milrad is a bigger company, right, with bigger market share. So their, volatility, their, returns volatility is much lower, right? Less risky. It means Antex smaller firm, so they are riskier. So beta is higher. Orion's beta is very good compared to, I would say, very stable and steady, right? Uh, but it's because Orion is not only currently not in the military market, but it's in civilian market. So they must have been uh, successful in the civilian market, and they are trying to venture into the military market. So this is a new venture, right? You understand? The return on average publicly traded stock, so market return, right, is about 10%. The yield on short-term treasury, risk-free return is currently 5%. Orion's weighted average cost of capital is 8%. Currently, their Orion's weighted average cost of capital is 8%. So the military radio project is expected to require an initial outlay of uh, 10 million, right? Initial investment of 10 million. Subsequent cash inflows are expected to be 3 million per year over the next 5 year, over a 5 year contract. So there will be, first initial investment of 10 million, then 3 million, 3 million, 3 million for 5 years, right? The cash inflow of on the basis of a 5 year evaluation, should Orion undertake the project? So although currently Orion's cost of capital is 8%, but using, CAPM, what should be its risk adjusted, right? What should be its risk adjusted cost of capital, right? And then we calculate the net present value or internal rate of return and see if this project is military market, venturing into military market is worth taking. Okay, so estimating risk-adjusted rate of beta. First of all, although Orion's beta is 1.1, but this is the beta based on their existing business, right? Which is, a civilian market. But if it is military market, you cannot use that beta. So because military radio business is riskier than Orion's current business, Milred and Antex, both pure play firms, they are pure play because they are doing only military radios. But Milred probably has less risk than Antex, right? Since it is the market leader. Orion will be similar to Antex because Orion is a newcomer in the military radio market. So we would use Antex's beta of 2 to evaluate the project. Then calculate the risk-adjusted cost of capital for the project. So KO then is Orion's cost of capital, right? Risk-free return, right? Treasury bill, right? Plus, market return minus, right? Risk-free times beta. It comes to 15%. And then if you calculate the project's NPV using 15% risk-adjusted cost of capital, then it comes to 0.1 million, 0.1. So then think about it. Since the net present value it's positive, but it's barely positive. So the project is marginal at best. It's marginally acceptable, right? So then the question is, do you take this project or not? And of course, the rule is, right, decision criteria is, as long as NPV is positive, you take it, accept the project. But it is, marginal. So is it worth, our question is, it's just marginal, right? Barely marginal. But if you want to expand into the military radio market, it's the risk worth taking, right? Makes sense. At least, net present value is not negative, right? So it depends on the company's, management's decision, right? If the management is the long-term goal is, not just, civilian market, but also military market, they will pursue this project, right? Now, evaluating the project at Orion's, original cost of capital, right, 8%, and of course, right, indicating acceptance. Adjusted for risk, however, the project is barely marginal, right? So management insight is crucial, right? Now, the problem with the theoretical approach is that it's difficult to find the pure play firm to obtain the appropriate beta. So that's what I said. It's difficult to find pure play. Betas of conglomerates are influenced by other divisions in other industries, and other divisions are all in other industries. Estimating betas by using firms in similar, although not exactly the same business, lowers the credibility, right? So systematic risk may not be the only, also the systematic risk may not be the only important risk. Total risk is important. Even higher risk adjusted rate is needed. If pure play division, but let's say, yeah, even, because, it's difficult to find the pure play firm, but at least some division in the divisions in the each company would be rather like pure play. For example, um, uh, within the same company, right? I would say, of course, Tesla and let me bring back that example of Tesla, Boring Company, and SpaceX. They are separate companies, but under the same umbrella. But if so, imagine that these three companies are actually three divisions in a single company under the same umbrella, right? Then each division is a pure play division, right? Then um, because you cannot obtain a beta of a pure play firm, then what would you do? You will need to the beta of that division using accounting beta method. What is accounting beta method? Accounting beta is simply uh, uh, using accounting records of like return on equity, right? Return on equity for that uh, division, because uh, stock price of this company doesn't reflect that pure play division. It reflects the conglomerate. So you look at the company's the division's accounting record, and look at the division's return on equity, and use that return on equity to regress. You regress that to find beta. You will have to run regression. You'll find, using by running the regression of the division's return on equity against the market return, then you can develop you can calculate, you can develop, security market line, like, the slope of the beta, right? The beta of that security market line, the regression line. And then that slope represents the division's beta, right? The slope of regression line represents a division's beta. Okay, so virtually every firm, in final note, every firm of every size uses capital budgeting techniques, but only a few overtly try to incorporate risk, right? So, in other words, it can become, very just, it can become not a very accurate picture, but rather a rule of thumb, right? It can become, if you're not being very, particular and meticulous about the risk adjustment, right? It can become a loosey-goosey picture, right? Now, business managers do recognize risk, but they do it through subjective judgments. Yeah, that's generally, what they call, experience, insight, management's insight. But actually, if you wanna, that is the reality. But that's rather, like a rule of thumb, right? So that's why we've been talking about incorporating real options in capital budgeting, right? and making risk adjustment, right? Using risk adjusted cost of capital. Okay, to make it more to improve our uh, capital budgeting uh, techniques, right? All right, so uh, that's it for today. So this wraps up everything about the real options. Okay, we'll move on to the capital structure and leverage in the next class. Thank you for watching, and I'll see you in the next class. End of video.